Welcome back to the Deep Dive. Today, we are really strapping in, getting ready for a focus session on a concept that, well, it's absolutely central to performance management.
Mhm.
It's a tool designed to, cut through the confusion you sometimes get with traditional accounting and really reveal true profitability. We're talking about activity-based costing, or ABC.
Yeah, ABC. And it's really more than just another costing method, isn't it? It's almost a strategic philosophy.
Philosophy. Interesting.
Well, yeah, because our mission today, it's to move well beyond just reciting a simple definition. We want you to deeply grasp the mechanics, understand the sort of hierarchy of costs involved, and crucially, the purpose of ABC.
Right.
We need to ensure you understand exactly why and how it improves managerial decision making. That's key for, both exam success and, frankly, your professional life afterwards.
Exactly. This is where we hopefully stop accepting numbers that might be distorted and start demanding accuracy. This dive is all about getting to that aha moment.
Flick.
Yeah, that click where you realize traditional costing is, well, often just not enough, especially for the complexities of, modern business.
And that realization, that's really our starting point today. Understanding the crucial flaw in that traditional way of thinking.
Okay, so let's begin right there at the foundation. What exactly is traditional costing, and why, particularly in businesses with lots of different products or maybe high-tech processes, is it sometimes seen as, well, structurally broken?
Right. So traditional costing, which is, the bedrock of absorption costing that many are familiar with, it's actually quite robust for the simple stuff.
Like direct cost.
Exactly. Direct material, direct labor, those are usually pretty easy. You can trace them directly to the unit being made. No real argument there. The complexity, the real headache, it comes entirely from how the indirect costs are handled.
The overheads.
The overheads, yes. Fixed costs, semi-variable overheads. That big bucket of costs that aren't directly tied to making one specific item.
The sort of black hole of cost allocation.
Precisely. And the traditional approach, historically, uses what we call a single volume-based absorption basis to kind of spread those fixed overheads across every single product.
One rate fits all.
Pretty much. Management chooses one metric, maybe it's direct labor hours, perhaps it's machine hours, and they apply this like blanket rate across the entire factory or maybe a whole department.
How do they get that rate?
Well, they take the total overhead cost pool for that factory or department, divided by the total estimated hours, labor, or machine, whichever they chose, and boom, that gives them one single overhead absorption rate, the OAR.
Okay, so the mechanism seems simple enough. If, say, product alpha takes 4 labor hours to make, it absorbs 4 times as much overhead cost as product beta, which maybe only takes 1 hour.
Correct.
It just assumes this straight linear relationship between the time spent working on something
Right.
and the amount of overhead cost it should carry.
And this is precisely where that popular but often deeply flawed analogy comes into play, the pizza analogy.
Oh, yes. Tell me about the pizza.
Okay, so imagine the total cost of ordering a bunch of pizzas for a group, including like the expensive truffle oil on one, the specialized gluten-free base for another, the delivery fees, the cost of running the pizza, and that whole pile of costs. That's your overhead pool.
Right, all the indirect stuff.
Exactly. Now, traditional costing says, okay, we'll split this total pizza bill based only on the size of the plate everyone used. Or maybe we'll split it based on how long each person spent eating.
But wait, that doesn't seem fair. The actual cost drivers for that pizza party aren't just plate size or eating time.
Go on.
Well, maybe one person made 10 phone calls, demanded loads of custom super expensive toppings, needed specialized handling because of allergies, things that cost a lot, but had nothing to do with how long they physically spent eating their slice.
You've absolutely hit the nail on the head. And that leads us directly to the crucial flaw in traditional costing. It fundamentally assumes that overhead consumption is purely driven by volume.
More hours, more cost. Simple as that.
More labor hours, more cost. More machine hours, more cost. But in modern manufacturing environments, which are often highly automated, maybe focused on complex customization, lots of quick product changeovers, that basic assumption, it just falls apart.
Why does it fall apart?
Because often the cost isn't really driven by volume anymore. It's driven by complexity, by the number of transactions, by the variety of activities needed, not just sheer production time.
So, okay, picture a business making a huge variety of products. Some are like dead simple, high volume runners. Others are really complex, maybe low volume custom jobs. If they rely on that single volume-based driver?
The costs get structurally distorted. It's almost
It's
guaranteed.
distorted how?
And the distortion, it's highly predictable, and it can be absolutely disastrous for making good management decisions. We call this phenomenon cross-subsidization.
Cross-subsidization, okay?
Yeah, and it typically works in two main directions. First, you've got your low-volume products. These are often the complex ones, right? They might require lots of specialized, non-time-based activities, think custom design time, frequent machine setups or changeovers, maybe extra rigorous quality inspections.
Okay.
Traditional costing undercosts these products. Why? Because they don't consume that many volume hours, labor, or machine. They look artificially cheap from an overhead perspective.
So they sort of fly under the radar, absorbing very little overhead cost, even though they might actually be resource hogs in terms of complexity and support.
Exactly. They're resource hogs, but the system doesn't see it. And then conversely, you've got the high volume, simple products, the ones that just run and run continuously with minimal fuss or
The
intervention.
bread and butter lines.
The bread and butter, yeah. Under traditional costing, these end up getting overcosted. They end up absorbing a huge chunk of the fixed overheads that were often actually generated by those complex specialty products simply because they consume a high volume of labor or machine hours. Their profitability looks artificially low.
Wow. So if I'm understanding this right, the simple, probably quite profitable product ends up, in effect, paying for the expensive, complex product, which might actually be losing money.
That's the essence of cross-subsidization.
Okay. So the purpose of activity-based costing, then, is to step in and eliminate this distortion completely, or at least reduce it significantly.
Precisely. ABC attempts to absorb overheads in a way that is dramatically more accurate and therefore much more useful for making decisions. It achieves this by recognizing that products don't just consume time, they consume specific activities, and it's those activities that actually drive the costs.
Right. Activities, not just hours.
ABC shifts the fundamental logic. We move away from focusing on a single measure of volume, like hours, and instead we focus intensely on the specific actions or activities that cause the cost to occur in the first place. This move from volume-based to activity-based thinking, that's the core conceptual shift you need to internalize before we even look at the mechanics.
Okay, right. Let's unpack this mechanism then. If traditional costing is potentially broken, then ABC is like the repair kit. We need to guide you, our listener, through the core logical steps of actually implementing ABC. It sounds like it's more involved than just calculating one rate.
Oh, it definitely is. It's a structured, systematic process. Typically, you can think of it in about, say, 6 key managerial steps. And the whole focus is on tracking costs back to their true causes, the activities.
Okay, step 1. This seems like maybe the biggest conceptual hurdle for management to get over, identifying major activities.
It really is, often because it forces management to look inwards, to really audit their entire resource consumption process in a way they might not have before. You have to identify the discrete, specific processes, the activities that truly incur overhead costs.
So we're moving away from these massive generic buckets like total factory overhead.
Exactly. We're moving away from that and trying to define measurable actions that require resources. Things like setting up a machine, receiving raw materials, inspecting finished goods, processing a customer order.
Can you give us a slightly more rigorous way to categorize these activities, especially for, our audience aiming for professional exams? We probably can't just list them randomly. There must be some structure to how costs are driven.
That's a really critical point, actually. ABC, particularly in its more sophisticated forms, distinguishes between 4 key levels of activities and their corresponding costs. Understanding this hierarchy is essential for real depth.
4 levels. Okay. Let's start at the bottom, the most basic level.
Right, that would be unit-level activities. These are tasks that are performed literally every single time one unit is produced. If you double your production volume, you pretty much double the consumption of these activities.
So what's the cost driver here? Still volume.
Often, yes. The cost driver for unit-level activities is usually still volume-based, like machine hours used for that unit or direct materials consumed. The actual machining process itself typically falls into this category.
Okay, makes sense. Moving up in complexity then.
Yeah,
You've mentioned things like setups, which aren't done for every single unit.
exactly. Those fall into the next level, batch-level activities. These are tasks performed only when a group or a batch of units is processed together. The key insight here is that the cost for these activities relates to the number of batches run, not the number of units within that batch.
Ah, okay. Like setting up a machine.
Perfect example, setup costs. The cost of doing the setup is pretty much the same whether you then produce 10 units in that batch or the 1,000 units. The cost is driven by the number of setups, not the volume produced after the setup.
What else falls into batch level?
Things like receiving materials, you typically receive a batch of materials from a supplier. Or dispatching orders, you dispatch a batch of goods to a customer. Maybe scheduling production runs. These are often the activities that cause the biggest distortion in traditional costing because low-volume products might require just as many setups or deliveries per period as high-volume ones, but they don't have the volume to absorb those costs traditionally.
Got it. Okay, level 3, there must be costs related to just keeping a product line going, regardless of units or batches.
Absolutely. Those are product-sustaining activities. These are costs incurred to support the existence of a specific product line itself, regardless of how many units or batches we run of that product.
Like what?
Examples might include product engineering specific to that line, maybe specialized research and development just for that product family, or the costs of writing and maintaining technical specifications or designs for it. The cost driver here is often something like the number of product lines the company supports, or maybe the complexity of the product design.
Okay, unit, batch, product. What's the final level? Just general factory costs.
That's essentially it. Facility-sustaining activities. These are the costs necessary simply to maintain the general manufacturing process or the business infrastructure as a whole. Think building security, factory lighting, property taxes, the factory manager's salary, building rent.
These sound hardest to link to specific products.
They absolutely are. These are the most difficult to assign accurately to specific products using a clear cause and effect driver. Often, the driver chosen might still be a general measure like floor space, or sometimes these facility-level costs might even be left outside the main ABC allocation if they're deemed too difficult or arbitrary to allocate accurately. They might just be treated as general business expenses.
That hierarchy unit, batch, product, facility that really helps clarify things. It shows that ABC is specifically designed to capture those batch and product level costs that traditional volume-based systems just miss or smear across everything. Okay, so we've done step 1, identified the activities using this hierarchy. Now we need to link them to their causes. Step 2, determining the cost driver.
Right. For each and every major activity you identified back in step 1, you now have to define the factor that causes the cost of that activity to occur. This cost driver is the metric, the measure that reflects the consumption of that activity.
So this is where we move away from the single driver, like labor hours, for everything.
This is the crucial insight, yes. We move away from that single, often inappropriate volume driver. Now, each activity gets its own most appropriate driver.
So like you said, if the activity is setup costs, the driver is logically the number of setups.
Sure.
If the activity is dispatching orders, the driver should be the number of dispatch orders processed. It has to reflect that cause and effect relationship.
Absolutely critical. The rigor required here is quite significant. Management can't just pick an easy metric that's already available. They have to pick a metric that genuinely correlates with, and ideally causes, the resource consumption for that activity.
Because if the driver is wrong...
If the driver is wrong, then the new ABC costs will still be wrong, just maybe wrong in a different way. The whole point is accuracy through causality. If a product causes setup activity, that product must be charged based on the number of setups it required.
Okay, sounds like a lot of analysis needed there. So, we know the activities, we know their drivers. Step 3 must be about finding the actual money involved, calculating the total cost pool.
Yes, this is where the hard accounting work often comes in. For every single activity you've identified, setups, receiving, machining, quality inspection, whatever they are, you now have to calculate the total overhead cost associated specifically with that activity.
How do you do that? Digging through the general ledger.
It involves gathering all the specific costs, fixed, variable, semi-variable that belong to, say, the team who performs the setups, or the resources used by the receiving department. This might involve salaries, depreciation on specialized equipment used only for that activity, utilities consumed by that area, supplies. It's a process sometimes called resource consumption accounting, tracing the money spent on resources back to the activities those resources support.
So if our total factory overhead in the old system was, say, $190,000, we're now meticulously breaking that big number down into maybe 6 smaller pools. Like $90,000 just for setups, $30,000 for receiving, $50,000 for machining, and so on.
That's the idea exactly. This decomposition, this breaking down of the big glob of overhead is where a huge amount of the implementation effort lies. It requires deep internal knowledge of how the business actually operates and consumes resources.
I imagine it's not always clear-cut. How do you split, say, the factory electricity bill between machining and receiving?
You're right, it's often not straightforward. This process might involve using more complex methods, maybe activity analysis, interviews with department managers, observation studies, maybe even installing submeters to estimate what percentage of a shared cost, like utilities or supervision, truly belongs to the machining cost pool versus the receiving cost pool. It requires judgment.
Okay, so it's complex, but we now have our accurate cost pools for each activity, and we know the total volume of the cost driver for each. Step 4 seems logical, calculating the absorption rate for each cost driver.
Exactly. Now we determine the cost per unit of activity. It's actually a pretty simple calculation at this stage. You take the total cost collected in the pool from step 3, and you divide it by the total estimated volume of its specific cost driver from step 2.
Okay, let's make that $90,000 setup cost pool concrete again. Let's say, based on our analysis or forecast, we anticipate performing a total of 25 setups across all our different products during the upcoming period.
Okay. Then the absorption rate for the setup activity is simply $90,000 divided by 25 total setups. That gives us $3,600 per setup.
$3,600 per setup.
That $3,600 is the activity cost rate. And it's a really profound number, actually, because it quantifies the true economic consequence, the cost burden, of demanding one more setup activity from the organization.
What does that $3,600 really cover, though? Is it just like the wages of the mechanic doing the physical setup?
Oh, no, it's much more than that. Ideally, it represents the entire economic burden that a single setup imposes on the company. So yes, it includes the wages and benefits of the setup crew, but it should also capture things like the depreciation on the specialized tools and jigs they use, maybe the cost of scrap material that's often generated during the test phase right after a setup, and crucially, something often missed: the opportunity cost of lost production time, the cost of that expensive machine sitting idle while the product changeover is being implemented.
Wow.
It aims to capture the true total cost impact of performing that batch-level activity.
That makes the rate much more powerful for management control, not just costing. Okay, so we have these highly specific activity rates. Now we just need to apply them to the products. Steps 5 and 6, calculating total overhead cost and cost per unit.
Exactly. Once all the different activity rates are known, the cost per setup, the cost per delivery received, the cost per machine hour, for unit level, the cost per engineering change order, etc., then the products are charged overhead based purely on how many units of each specific cost driver they actually consumed during their production run.
Let's use that conceptual example, product C, from the source material context. Say it's a low-volume product, maybe we only made 2,000 units, but during that run, it required, let's say, 2 complex setups, and our rate is $3,600 per setup.
Okay, then product C will absorb overhead costs related to setups calculated as 2 setups multiplied by the rate of $3,600 per setup. That equals $7,200 absorbed just from the setup cost pool.
And you do that for every activity.
You repeat that process for every single cost pool that product C touched. How many receiving orders did its materials require? Multiply by the cost per receiving order. How many dispatch orders did its finished goods generate? Multiply by the cost per dispatch. How many machine hours did it use? Multiply by the machine hour rate for the unit level costs. Did it trigger any product sustaining activities like a specific engineering review?
Yeah.
Add that cost in.
Okay.
Once you've totaled up all those absorbed overheads specifically traced to product C based on its activity consumption, you then divide that total overhead figure by the number of units produce, you said 2,000 units. And that gives you a dramatically more accurate overhead cost per unit for product C.
So fundamentally, ABC is all about meticulous tracing. It stops that cross-subsidization we talked about by forcing those low-volume, high-activity products to actually bear the full burden of the specialized, often expensive support activities they demand.
Precisely. It provides, ideally, a crystal clear picture of a product's true burden on the organization's often complex support structure, much clearer than just smearing costs based on labor hours.
Okay, we've really established the structural rigor behind ABC. It's clearly more detailed. But the real test, surely, is the outcome. Does it actually make a difference? You said ABC doesn't just change the numbers, it changes management perception and hopefully leads to better strategic decision-making by kind of shining a brutal, honest light on profitability.
Absolutely. This is where we get to the heart of why companies go through the pain of implementing ABC. It's about the cost distortion revelation. This is probably the single most compelling argument for using ABC, especially in complex environments.
Let's use that conceptual contrast you mentioned earlier, maybe drawing from the kind of results shown in examples like the one in the source material, to illustrate the potential managerial disaster that relying solely on traditional costing can create.
Okay, so under the old system, let's imagine overheads were absorbed using just one single volume rate. Let's say direct labor hours was the base. The initial picture, painted by the accounting system, suggested a fairly clear strategy for management.
What did it show?
Well, it was deceptively simple and dangerously misleading. The traditional accounting report revealed that product A, which happened to be a high-volume item, looked like a loser. It was showing, let's say conceptually, a $1.68 loss per unit sold.
Okay, product A looks bad. What about the others?
Conversely, the other products, let's call them B and C, maybe lower volume, more specialty items, they looked fantastic. Both were reporting a healthy profit, perhaps around $2.16 per unit each.
Right, so any rational manager looking purely at that traditional costing report would immediately think, what?
They'd look at discontinuing product A, right? It's losing money.
Yeah.
And they'd probably look to heavily promote and maybe even expand production of products B and C, the apparent winners. That seems like a perfectly logical, data-driven decision based on the report.
It does seem logical based on that data.
It's the logical decision based on flawed data. Because when the company then implemented activity-based costing, meticulously tracing costs back to those unit, batch, product, and facility-level activities we discussed, the truth turned out to be almost the complete opposite.
How so?
Product A, the one that looked like a loser under traditional costing, was revealed by ABC to actually be clearly profitable. Maybe it was now showing a $1.10 profit per unit, a complete turnaround.
Okay, so A is actually good. What about B and C?
Product B, under ABC, maybe it remained profitable, perhaps showing a $1.21 profit per unit, so still okay, though maybe less stellar than originally thought. But the real shocker was product C.
The supposed star performer.
The supposed star. Under the accurate lens of ABC, product C was revealed to be seriously bleeding cash. It was now showing a significant loss, let's say $3.63 per unit.
Wow. That's a swing of nearly $6 per unit in perceived profitability for product C. From a $2.16 profit to a $3.63 loss.
It's a monumental shift in understanding. And it forces us, as managers or analysts, to ask the critical question: why did product C look so profitable before? And why did A look so bad? This gets right back to the core teaching moment about cross-subsidization.
Let's just quickly detail the likely profiles of product A and product C again to really hammer home the mechanism of that distortion.
Sure. Product A is the classic example of a simple high-volume item. It probably runs on the machines constantly, requires very few setups, maybe uses standard materials, needs minimal special handling, smooth sailing.
Okay.
But because it consumed a high volume of labor hours or machine hours, the traditional costing system penalized it heavily. It got loaded up with a large share of the total factory overhead pool, making it look unprofitable. In reality, it was a smooth, low-maintenance product that was absorbing costs actually generated elsewhere in the factory. It was being overcosted.
Right. In product C,
Product C, however, was the mirror image. It was a low-volume product, maybe only 2,000 units produced in the period, meaning it consumed very few total labor or machine hours overall. So under traditional accounting, it absorbed almost no overhead cost, allowing it to look highly profitable based just on its direct costs versus selling price.
but the reality was different.
But look at the activities it demanded, particularly those expensive batch-level costs and maybe even product-sustaining costs. Although it only produced 2,000 units, perhaps it required a disproportionately high number of specialized, time-consuming machine setups. Maybe it needed frequent, small deliveries of unique raw materials, driving up receiving costs. Maybe it required unique, rigorous quality control checks after each batch. Perhaps it needed custom packaging or specialized dispatch processes.
So it was generating lots of costly transactions.
Exactly. These batch-level and potentially product-level activities are expensive. And because the traditional accounting system just buried these costs in the huge overall factory overhead pool and spread them based on volume, they weren't assigned correctly to the product that actually caused them. Product C was a genuine cost hog when it came to demanding these high-cost support activities.
So the traditional system essentially gave product C a free ride. It allowed it to look good by charging the cost of its complex support structure to the high-volume products like A.
That is precisely what happens with cross-subsidization. Product A was subsidizing product C.
The managerial impact here is just profound, isn't it?
It's huge. Think about it. If management had acted solely on that initial traditional data, they would likely have accelerated the production of the loss-making product C and maybe even cut back production of the genuinely profitable product A. That path leads directly to eroding the company's overall bottom line, possibly quite rapidly.
Whereas ABC provides the clarity needed.
ABC provides the necessary clarity, the more accurate picture, to make correct decisions. Correct pricing decisions. For instance, maybe product C needs a significant price increase or needs to be redesigned to reduce its activity consumption. Correct decisions about negotiating volume discounts strategically. And perhaps most importantly, correctly identifying which products genuinely need redesigning, repricing, or maybe even discontinuation. It avoids those disastrous decisions based on phantom
I
profits.
think the big lesson here then is that while ABC is often presented as just a tool for better cost accuracy, it's fundamentally a tool for survival and strategic advantage in a complex market.
Absolutely. Knowing your true costs is foundational. And this core concept, the idea of tying overhead costs back to the specific activities that drive them, it's so robust, so logical, that its principles extend far beyond just calculating the manufacturing cost of a physical product.
Where else does this thinking apply?
Well, let's talk briefly about a key modern application that builds directly on ABC logic. Environmental activity-based costing, often shortened to EABC.
Ah, right. Strategic cost management often requires isolating and understanding costs that management might prefer to ignore or just bury in general overhead. And environmental costs, waste disposal, pollution control, compliance, they're a classic example of that, aren't they?
You really are. How does EABC adapt the ADC methodology to handle these?
Well, environmental management accounting, or EMA as a broader field, demands that organizations properly account for things like the efficient use of natural resources, the costs of waste disposal, preventing pollution, and meeting environmental regulations. In traditional accounting systems, the costs associated with running, say, the company's sewage treatment plant or hauling away hazardous waste or paying potential environmental fines, these often just get lost in huge, amorphous, general overhead accounts. Yeah, they just seem like unavoidable fixed costs of doing business. Managers might feel they can't control them.
Exactly. They get treated as uncontrollable overheads. EABC challenges that by applying the rigor of ABC specifically to these costs. Instead of lumping all environment-related costs into general factory overhead or administrative expenses, EABC attempts to attribute these costs to specific joint environmental cost centers or activity pools.
So you might establish an activity cost pool specifically for, say, hazardous waste processing.
Precisely. And then you'd need to identify the most appropriate cost driver. For hazardous waste processing, the driver might be the volume of hazardous waste generated, perhaps measured in liters or kilograms. Another environmental activity pool might be water purification, and its driver could be the cubic meters of water consumed by different processes or products.
Okay.
By establishing these specific environmental activity centers and their drivers, EABC forces management to explicitly identify, measure, and then attempt to attribute these often substantial environmental costs back to the specific products, processes, or departments that cause them to be incurred.
What's the real strategic value here, though? Is it just about getting slightly more accurate product costs by including environmental overheads? Or is there more to it?
It goes beyond just attribution accuracy. The real value often lies in changing behavior and driving efficiency. By making the environmental cost impact transparent and linking it directly to the activities that cause it, EABC can significantly affect strategic decisions.
Oh, so
Well, imagine product Y requires raw materials that, during processing, result in unusually high volumes of hazardous waste. Traditional costing might hide that impact, but EABC will clearly show that product Y is actually much more expensive to produce than previously thought once you correctly allocate the high cost of processing its specific waste stream.
so management sees the true cost.
Yes, and seeing that true, higher cost might then incentivize management to actively search for, say, less harmful alternative raw materials, even if those alternative materials have a slightly higher purchase price up front. Why? Because the total cost, including the now accurately reflected cost of waste disposal and environmental processing, might actually be lower overall.
So it fundamentally changes the economic trade-off calculation. It makes sustainability financially visible.
Exactly. It acts as a powerful tool for driving sustainability through financial transparency. It creates a much clearer, more direct link between a product's or process's environmental impact and its ultimate financial performance. This forces management attention onto resource efficiency, waste minimization, and pollution prevention before these things become expensive downstream disposal or compliance problems.
Okay, this is where we really get into the practical side, the nuts and bolts of actually using ABC. We understand its conceptual superiority. We see how it can reveal hidden truths about profitability and even environmental impact. But what are the direct, measurable benefits it provides in the sort of day-to-day control phase of management? And equally importantly, what are the typical stumbling blocks, the real-world challenges when companies try to make this work?
Right. ABC definitely offers tangible advantages that go directly to the heart of effective performance management, but it's certainly not without its hurdles.
Let's start with the positives. What's the clearest benefit management sees when they implement ABC properly? You mentioned visibility earlier.
Yeah, I think enhanced cost visibility is probably the most immediate and powerful advantage. Traditional systems, with their huge overhead pools, tend to obscure where the money is actually going. ADC, by its very nature, shines a bright spotlight on the costs of specific activities, especially those non-unit level ones like setups, engineering changes, material handling, quality inspections.
So you see the cost of a setup, for example.
Exactly. By creating separate, identifiable cost pools for these activities, ABC provides very clear targets for cost reduction efforts and for process improvement initiatives. Management stops asking vague questions like, how do we cut total factory overhead by 10%? And starts asking much more targeted, actionable questions like, why is a single machine setup costing us $3,600? Can we use lean manufacturing principles or maybe invest in automation to reduce the time, the resources, the scrap associated with that specific activity?
That makes sense. Seeing the cost drives action. And that improved visibility must lead directly to the second major advantage you often hear about: better resource allocation.
It absolutely should, because the costs assigned to individual products, services, or even customers are vastly more accurate under ADC. Management is equipped to make much more informed, highly data-driven decisions across the board. Well, they can set optimal pricing strategies based on true product margins, not distorted ones. They can confidently decide on the most profitable product mix to focus on. They can evaluate special order requests accurately, knowing the true incremental activity costs involved. And, crucially, they can make sound decisions about potentially discontinuing genuinely unprofitable lines while avoiding the trap of cutting a product that traditional costing said was unprofitable, but ABC reveals is actually a hidden gem.
So it minimizes the risk of those bad decisions driven by cross-subsidization.
Exactly. It reduces the risk of killing profitable products or, perhaps even worse, pouring resources into promoting and expanding products that are secretly losing the company money hand over fist.
And we also touched on how ABC supports other modern management techniques, like the EABC example. You also mentioned its principles are leveraged powerfully when it comes to controlling ongoing operations through variance analysis.
Correct. Ultimately, the aim of any good costing system isn't just to report historical costs, it's to help control future costs and improve performance. ABC provides a superior framework for performing overhead variance analysis compared to traditional methods.
How so? How does it change variance analysis?
It changes the focus. Traditional overhead variance analysis often focuses heavily on just spending less money overall, expenditure variance, and maybe on labor or machine efficiency. ABC allows for a more nuanced analysis because it shifts the focus from just cost reduction in the overhead pool to also promoting the efficient use of the overhead activity driver itself. It allows us to break down the total overhead variance in a much more meaningful way, linking it back to activity management.
Okay, let's elaborate on that breakdown. How does ABC typically split the total overhead variance? I assume there's still an expenditure variance.
Yes, the first component is usually still the standard, but nonetheless critical overhead expenditure variance.
What does that tell us?
The expenditure variance is pretty straightforward, conceptually. It asks a simple question. Did we spend more or less money than we budgeted for the total cost pool associated with a specific activity? For example, if the budgeted cost pool for running the entire setup department for the period was $90,000, but the actual costs incurred, salaries, depreciation, supplies, etc., came to $95,000, then we have an adverse expenditure variance of $5,000 for that activity pool.
So it's about controlling the total money spent on that activity pool's resources.
Exactly. Did we overspend or underspend the budget for the resources dedicated to performing setups.
Okay, and the second component, you said this one really reflects the ABC philosophy. That's the overhead efficiency variance.
That's right. And this is where the control aspect gets really interesting because it's focused on the driver of the activity. The efficiency variance in an ABC context primarily looks at whether we use the resources in the cost pool, which we spent money on, measured by the expenditure variance, to achieve the most activity output possible, measured by the cost driver.
Can you give an example?
Let's stick with setups. We budgeted the $90,000 cost pool to be able to support, say, 25 setups during the period. That gave us our $3,600 per setup rate. Now, let's say we actually performed 30 setups during the period using the same budgeted resources, or maybe slightly more or less, which the expenditure variance captures. The fact that we got more setups done than planned for the budgeted resource level generates a favorable efficiency variance.
Why favorable?
Because it means the setup team or the process itself was more efficient in terms of its output. They handled more work, they increased the volume of the cost driver setups performed, potentially for the same or similar fixed investment in resources.
Okay. So the goal isn't just to cut the total budget for the setup department, but also to ensure that the resources we do commit to performing setups are used as efficiently as possible to maximize the number of setup tasks they can handle. It's about maximizing the capacity usage, the throughput of that activity center.
You've got it. That dual breakdown expenditure and efficiency gives management much more granular control levers. Did we spend too much on the resources expenditure? And did we get enough activity output from those resources, the efficiency?
That's much more insightful than just a total overhead variance.
It is. However, there is a crucial caveat here, maybe a slightly technical point, but important for our audience who might be digging deeper for exams. The efficiency variance in ABC, especially for batch, product, or facility-level activities, which often have significant fixed costs, isn't always about pure physical efficiency in the way we think about, say, direct labor efficiency, using fewer hours.
What is it about then?
It's often more a measure of capacity utilization. If you have an activity cost pool dominated by fixed costs, like the annual salaries of the receiving department staff, then a favorable efficiency variance might simply mean they managed to process more deliveries, the cost driver, than were originally planned when the budget was set, using essentially the same fixed staff capacity. It measures how well you utilize the planned resources, the capacity you paid for that activity.
That distinction is important. It connects back to those higher-level costs we discussed, the facility and product-sustaining costs. For those, you've invested in a certain capacity, like an R&D team or a factory building. And the efficiency variance helps track whether you're getting the planned activity throughput from that investment. You want to make sure the capacity you've bought isn't just sitting idle.
Precisely. If you invest heavily in a complex R&D department, classic product sustaining costs, the efficiency variance might relate to whether that department effectively managed to process the maximum number of new product specifications or engineering change requests, the relevant product level drivers, possible with its budgeted headcount and resources. Are we getting our money's worth from that capacity?
Okay, this all makes ABC sound incredibly powerful, and conceptually it feels far superior to traditional methods. But, and there's always a but, if it's so much better, why hasn't every single company on the planet adopted it? What are the common problems, the practical challenges that management bumps up against when they actually try to implement and run an ABC system?
Yes, the reality check. The jump from the relative simplicity of traditional absorption costing to a full-blown ABC system is often enormous, which brings us squarely to the first major and perhaps most significant hurdle: complexity and time.
It just looks significantly more complex than calculating one single OAR.
Oh, exponentially more complex, typically. Implementing ABC requires a massive upfront investment in time, significant technical expertise, often from cost accountants and operational managers working together, and substantial organizational resources. You have to identify potentially dozens, maybe even hundreds, of distinct major activities across the organization. You need to define and calculate costs for multiple cost pools. And then you have to meticulously track the consumption of resources across numerous different cost drivers.
That sounds like a huge project.
It is. It often involves extensive data gathering, interviewing personnel, maybe conducting time and motion studies, analyzing process maps just to understand the activities and drivers. And crucially, it's not a one-off exercise. The system requires constant maintenance and updating as processes change, products evolve, and costs shift. It's far, far more time-consuming and therefore expensive to develop and operate than traditional costing systems. This cost and complexity mean it's usually only truly cost-effective for companies that have genuinely high overhead costs to begin with and/or highly complex product or service mixes where the risk of cost distortion is severe.
Okay, complexity and cost, that's a big one. I can also imagine that the initial process, just defining the activities and choosing the drivers, could be fraught with, well, internal politics and managerial friction.
You're absolutely right. That brings us neatly to the second major challenge area: subjectivity and judgment. While ABC strives for objectivity, the process inherently involves significant subjective decisions.
Like what?
Well, just defining what constitutes a major activity is highly subjective. Which of the hundreds of individual tasks performed in a factory should be aggregated together into the single activity pool called receiving? Where do you draw the boundaries?
And choosing the driver must be tricky too.
Critically so. Choosing the single best cost driver for each activity pool is often a matter of expert judgment and debate, not always pure, unambiguous data. If a particular support department seems to be driven by both the number of machine hours and the number of production runs, which one do you choose as the primary driver for allocating its costs? Different choices can lead to different results.
I guess you run the risk of choosing what we might call a surrogate driver, something that's easy to measure, maybe data you already collect, but doesn't actually reflect the true underlying cause of the resource consumption. Just to simplify the system.
That is a very real danger. If you choose a poor or inaccurate surrogate driver just because it's convenient, you fundamentally undermine the entire purpose of ABC, which was to achieve greater accuracy. You've invested all that time and money in identifying activities and pools only to allocate the costs using a flawed metric. Getting genuine managerial consensus and buy-in on these crucial definitions of activities and drivers is often one of the biggest practical implementation barriers.
Okay, complexity, subjectivity.
Yeah.
What's the third big one? It must be about the information needed.
Absolutely. The third major challenge is the sheer data requirement and the impact on information systems. Traditional accounting systems are typically set up primarily to record time, direct labor hours, machine hours, and maybe material quantities.
So the ABC needs activity counts.
Exactly. Implementing ABC demands substantial, often quite costly, changes to the company's internal information systems, data collection processes, and potentially even shop floor tracking methods. The system now needs to be able to accurately and efficiently record activity consumption. It needs to track the number of setups performed for each product, the number of purchase orders raised, the number of quality inspection reports generated, the number of customer service calls handled, the number of design changes implemented, metrics that may never have been systematically recorded or tracked at the product or customer level before.
So you might need new software, new processes.
Very likely. If the underlying data capture system is unreliable, inaccurate, or simply too expensive and cumbersome to operate, then the ABC implementation will likely fail, or the resulting information will be untrustworthy.
So pulling it all together, ABC is this phenomenal conceptual tool, potentially transformative for decision-making, but it's a huge undertaking. The decision to adopt it isn't trivial. It requires a serious commitment to dealing with complexity, navigating organizational subjectivity, and achieving consensus, and likely overhauling the underlying data capture and information systems.
It's a classic management trade-off, isn't it? You're essentially trading the relative simplicity and cheapness of traditional costing, which provides potentially misleading data, for the significantly higher complexity and expense of ABC, which aims to provide highly accurate, decision-critical data. It's an investment decision that needs careful consideration of the costs versus the benefits in a company's specific context. #OTRO.
Right, we've reached the end of our pretty intensive deep dive into activity-based costing. Just to quickly recap the absolute key takeaways for you to lock in for your performance management mastery. ABC is such a critical tool primarily because it forces that essential shift in focus away from simplistic volume metrics, like labor hours, towards the actual activities that consume resources. And by doing that, it corrects, or at least significantly reduces, that dangerous cost distortion, that cross-subsidization, which is often caused by traditional single-rate absorption costing.
Yeah, and this improved methodology reveals much truer product or service or customer profitability. That knowledge is absolutely essential for making accurate pricing decisions, for guiding strategic planning about product mix or market focus, And crucially, for preventing that potential financial disaster of unknowingly subsidizing loss-making parts of the business.
And we saw its structure is robust, too, allowing us to apply its core principles to important strategic areas like environmental activity-based costing, helping to drive efficiency and sustainability by making those costs visible.
Exactly.
So if you found this deep dive helpful, and perhaps you're looking to really master these kinds of concepts for your ACCA exams or just your professional development, make sure to subscribe to the SmartPass YouTube channel. You'll find more ACCA performance management lessons, study strategies, and audio guides just like this one, all designed to help you succeed.
And maybe just one final thought for you, the listener, to carry forward from our discussion today. Remember, truly mastering activity-based costing isn't really about just memorizing the 6 calculation steps. That's important, yes, but the real goal is understanding the fundamental logic that underpins the superior decision-making power it provides.
The why behind it.
Exactly. It forces management and you as a future manager or advisor to understand what truly drives costs within the organization, not just where those costs happen to land in the accounting system. That deeper understanding is the real value.
That's a great point. And just to reinforce that idea of its broad applicability, maybe ask yourself this question. Consider a complex service industry this time, perhaps like a high-end management consulting firm. Traditionally, they might allocate all their firm overheads based simply on billable consultant labor hours,
Right?
right?
Very common practice.
Okay, now, how might applying ABC principles, identifying specific activities like, say, complex client onboarding, which involves extensive regulatory filing and bespoke legal checks, or multi-stage proposal generation, which requires input and sign-off from multiple senior partners. How might that radically alter how that consulting firm views the true profitability of its various clients or service lines?
Well, it very well might reveal something quite startling. It might show that the client who pays the highest hourly billing rate, the one everyone assumes is the most profitable, is actually one of the least profitable once you accurately account for the dozens of specific high-cost, batch-level administrative, compliance, and senior management review activities that that particular client demands.
Activities whose costs are currently just being smeared across all clients based on billable hours.
Exactly. Costs which are currently being effectively absorbed or subsidized by the firm's simpler, less demanding clients who require fewer of those complex support activities. ABC would ensure that the client who requires the most support, the most activity, actually pays appropriately for that support. It reveals the true cost to serve.
That really brings it home. That's the power of knowing what truly drives your costs,
Yeah.
regardless of the industry. Fantastic. Well, that's all the time we have for today. We'll catch you next time for the next deep dive.